Ladies and gentlemen, good day, and welcome to the GRP Ltd Q1 FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all the participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harsh Gandhi, Managing Director of GRP Ltd, for his opening remarks. Thank you, and over to you, sir.
Thank you so much, and a very good afternoon, ladies and gentlemen. Thank you for joining us on the GRP Ltd's Q1 FY2025 earnings conference call. Along with me today, I have our company's CFO, Shilpa Mehta, and SGA, our investor relations advisors, on the call. We have uploaded our investor presentation on the stock exchanges and on the website, and I hope each of you have had the opportunity to go through the same. The past few months have been particularly an exciting period for all of us at GRP. As we celebrated 50 years, we are looking at this as an opportunity to look ahead to the strategic opportunities and promising prospects that await our company in the years to come. In light of the recent industry developments, we are actively exploring various potential adjacencies to capitalize on our existing strengths. These developments are based on brand owner interest, government interest, as well as the consumer push. We're pleased to announce that the board has approved several of our capex plans, and details of which I shall share during the course of the call. However, before getting into it, I'd like to provide an overview of the quarter and an update on the key focus areas outlined in the previous calls, along with the progress that has been made on each of those fronts. As you've seen from the financial statements, our performance on an operational basis for the quarter ending June 2024 was reasonably robust. Our revenues rose from 999 million INR to 1.267 billion INR, reflecting a growth of about 27% compared to the same quarter last year. Our EBITDA for the quarter saw a significant improvement, increasing to 132 million, an 88% rise compared to the same period last year. And our PAT for the quarter marked a growth of about 122%. Let me take you through what's happening in the industry around us, and then as a result of it, what are the changes that are taking place in the company. Starting with the reclaimed rubber business, I'd like to highlight that the global tire market has experienced a 3% growth in the passenger car and light truck segments during the half year of calendar year 2024, while demand in the truck tire segment, excluding China, grew by about 2%, with most of the downturn coming through in the European market. Despite slowdowns in export markets on the whole, we have achieved as GRP a 13% year-on-year growth in our export volume of reclaimed rubber. This growth could have been even higher had it not been for constraints arising from the Red Sea crisis and the resultant unstable container availability. On the domestic front, rubber consumption has increased by about 5% in Q4 of FY24, which is the last reported numbers, but that same momentum continued in the Q1 of FY25, allowing our reclaimed rubber segment to post a 43% year-on-year growth, driven by higher volumes and EPR income. Overall, our reclaimed rubber revenues grew by about 24% year-over-year to 111.2 crore or 1.112 billion rupees, accounting for 91% of our total standalone revenue. Year-over-year, virgin natural rubber prices have risen due to a demand-supply imbalance, while synthetic rubber prices also remain elevated, driven by high crude oil prices and shipping costs resulting from the political tensions in the Middle East. Amidst these challenges, our realizations have marginally declined by about 2 to 2.5% due to the reduced share of exports, and that in turn has been caused by the prolonged crisis in the Red Sea. We are also seeing that there is a marginal increase in freight costs, and all of which we are unable to pass through to our customers, and that has also resulted in a partial reduction in the margin on the export business of the reclaimed rubber. However, I must admit, demand remains fairly robust. We are sweating our assets and capacity utilizations remain much higher than before, and we are confident on maintaining a healthy double-digit EBITDA margin, supported by the savings in energy costs that have been planned and also the addition of the EPR income. In our efforts to transition to a renewable energy sources to get to about 50% of our stated target, our energy cost savings through a combination of windmills, biofuels, etc., have amounted to about 1.65 crores or 16.5 million rupees in the current quarter. The biofuel system, which became fully operational towards the end of Q1, is expected to generate additional savings over the next quarters, in addition to the reduction in the CO2 emissions going forward. As our customers focus increasingly on reducing their emissions from scope 1, 2, and 3, our energy substitution towards renewable sources will go a long way in establishing our credibility in the industry. We recorded an EPR income of about 6 crores during the quarter, reflecting our proactive engagement in this regulation. The CPCB is in the process of finalizing the mechanism to set up the environment compensation, and as a result, the price range of the EPR units or EPR credits will get finalized, hopefully in the current month, and that will allow us to be able to predict better the potential revenues on account of the EPR income, EPR credit sale. As announced earlier, our new technology based on lower CO2 emissions and improved product quality are under evaluation with several customers, and we expect the added capacity to be formally commercialized in the current quarter and expect commercial volumes to begin from Q3 of this year and achieve close to 50% utilization towards the end of the year. The company has consistently maintained a working capital cycle of 75 days, and we continue to, in light of all the challenges in the non-tire sector and even some of the other markets around the world, we continue to maintain and ensure that the same cash flow discipline continues in the organization. As far as the non-reclaimed businesses are concerned, we have been diligently focusing on this segment, achieving significant market traction. This focus, combined with the low base from the previous year following a fire incident, has led to a 25% year-on-year growth in the overall revenues, which now represent 9% of our standalone revenues. This, however, does not include revenues from our subsidiary company, GRP Circular Solutions Ltd, which produces the repurposed polyolefins. Our volumes in the non-reclaimed rubber segment have increased in line with the auto industry growth, and that has been about 10%. But as far as the engineering plastics is concerned, there has been a significant addition of business using alternate raw material sources such as textile and fishnet waste. And I spoke about the possibility of using the ocean plastics for our advantage. Happy to say that we have been able to commence sales from that sector. However, since these are bought out materials and raw materials, our margins from these type of engineering plastics will be lower than the margins from the core raw material which comes from the tire recycling facility. The non-reclaimed rubber segment is showing promising potential and delivering healthy margins. As this business continues to scale, we anticipate further improvements in the EBITDA margin due to economies of scale. As guided in our previous earnings call, GRP is making significant strides in response to the emerging clarity in the EPR regulation and the resultant incentives for the various tire recycling technologies. As a result, we have acquired land adjoining our existing facility in Sholapur to set up a crumb rubber plant and venture into downstream recycling over the coming years. This downstream activities will focus on manufacturing of crumb rubber as well as possible areas along the lines of energy through the use of pyrolysis and recovered carbon black. The board, to support the above initiative, has announced and approved a capital expenditure of up to 250 crores. This investment will be executed in two phases over a period of the next 3 years, of which 150 crores will be deployed until December 2025, and the remaining amount to be utilized thereafter based on the success of the first phase of the projects. As I indicated before, the focus areas of the CapEx will be on deployment of new technology to produce reclaimed rubber with lower CO2 emissions, expansion of capabilities in crumb rubber and other categories identified under tire EPR, and also the expansion of the plastic recycling business. The total funding requirement for these projects, as of now, we believe will be met through a combination of internal accruals and debt, and at whatever time as we deem appropriate as far as the debt is concerned. The planned expansion for these projects will be carried out at the current sites of the company. We have sites in Sholapur and Dahej, and these would be the likely locations for the next rounds of expansion. This strategic investment underscores our commitment to the sustainable growth story and also positioning GRP for continued success in the evolving recycling ecosystem. By deploying these new technologies and expanding our capabilities, we are ensuring that we remain at the forefront of innovation and sustainability. With this background and highlights of the operations out of the way, let me hand over the call to Shilpa to take you through the financial highlights for the quarter. Thank you.
Good afternoon, everyone. Let me take you through the consolidated financial highlights for Q1 of FY25. Total income in Q1 FY25 was at rupees 1,267 million as compared to rupees 999 million in Q1 of FY24. So there is an improvement of 27% on year-on-year basis. We recorded an EPR income of rupees 6 crores during the quarter. Gross profit for Q1 FY25 was rupees 670 million as compared to rupees 520 million in Q1 FY24. So there is an increase of 27% on year-on-year basis. EBITDA for Q1 FY25 stood at rupees 132 million as compared to rupees 70 million in Q1 of FY24, which is an increase of 88% on year-on-year basis. This was driven by the gain from EPR and a reduction in energy cost. EBITDA margins for Q1 FY25 is at 10.46% as compared to 7.05% of the Q1 of FY24. There is an increase of 341 basis points on year-on-year basis. PAT for Q1 FY25 is rupees 44 million as compared to rupees 20 million in Q1 of FY24. With this, I now open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Divya Agarwal from Ficom Family Office. Please go ahead.
Hi sir, thanks for the opportunity. Am I audible?
Yes, you are.
Okay, so my first question is on the crumb rubber capacity that we are setting up. So, I mean, micronized rubber product, MRP, is another downstream product of crumb rubber. So, I just wanted to know your thoughts on that, and maybe do we have any plans of further going down to producing MRP?
Thank you for the question. MRP is one form or type of crumb rubber. As part of our expansion into crumb rubber, we will look at different sizes. Micronized is essentially defined as a certain size of crumb rubber. So yes, as part of the entire investment in crumb rubber, we will be looking at different size of materials to offer to different end applications. As far as the total capacity is concerned, and phase 1, the total capacity of crumb rubber that we will set up will be to the extent of about 40 to 50,000 tons.
40 to 50,000 in first phase or both the phase including?
This will be the first phase.
Okay. And so my second question is, pardon my knowledge of limited tire recycling. So I just wanted to know if, this MRP could be used along with the reclaimed rubber, or this could be like different thing?
The MRP, so as I mentioned before, MRP is a terminology used for micronized. The micronized is essentially anything that is ground below a certain size. There are various applications for the different sizes of crumb rubber, ranging from tires to non-tire applications to even certain kind of molded other rubber products. So as I said, I mean, depending on the customer preferences and the opportunity, we will invest in different sizes of crumb rubber to be able to grow in.
Okay, sir. Got it. Thanks a lot.
Thank you. The next question is from the line of Rohit from Marshmallow Capital. Please go ahead.
Thank you for the opportunity. So my first question on the new project. So we mentioned, I mean, 250 crore, we mentioned that we are looking to fund it internally or through debt. So just wanted to understand if you could share what is, I mean, how do you measure the maximum amount of debt that we are willing to take? Is it on a debt equity, is it on a debt EBITDA? If you could help us understand, that would be helpful. So I want to also understand, would this debt to EBITDA that you're looking at include the working capital or short-term debt, or it will be only long-term debt?
So I think some of this fine-combing of the debt equity and some of these final numbers are still in the works, and hopefully you'll be able to provide clarity on this in the subsequent calls. But as of today, we have reasonable confidence on the company's ability to generate internal cash, supported by margin improvement, volume growth, as well as the EPR income. And that allows us to be able to leverage to the extent that the balance sheet can handle. As I mentioned, therefore, that the first phase of investment would be about 150 crores. We also have approval of the shareholders to raise rights issue of up to 40 crores. So if you look at a combination of the rights issue that is approved by the shareholders, debt and internal accruals, the first phase of the investment will be funded through a combination of these three sources. As far as the second phase is concerned, hopefully by the time the investment in the first stage starts to accrue additional cash flows, we will take a call at that stage appropriately about the level of infusion of debt or any other means as may be required. And your second question was what is the comfortable debt to EBITDA or debt to equity ratio? I mean, as an organization on a long term, or rather at a what do you call it? From a debt equity perspective, currently our debt EBITDA is trending at closer to about 1.6 or thereabouts, and a debt equity on a total, including the short term debt, is at about 0.7%. So we're fairly confident that given the predictability of the cash flows and the current both nature of debt equity as well as debt EBITDA, we believe that we have the ability to raise additional debt. I hope that answers your question.
No, yeah. So that is very helpful. But is there a maximum debt EBITDA? I mean, as on a prudence basis, we don't want to go beyond. Is it 2, 3, something like that? Is there some number that can be shared?
I mean, these are obviously conversations that we are having at the board level. I think we are very clear that we will not exceed debt to EBITDA of more than 2.5. I mean, that is something that we would be fairly comfortable up to that level. Anything beyond that, we may not be comfortable taking on. So, but, yeah, I mean, yeah.
That was helpful. And one more on this expansion. So 150 crores till December 2025 on phase 1. So I believe the 40 to 50,000 ton capacity expansion that we're planning in the as part of the first phase is coming by Q3 of this year. So any thoughts on the capex of that particular facility and the ramp-up period there?
Yes, so the 150 includes already the capex that is already being spent on the plant to produce the crumb rubber by Q3 of this year. So it's this investment is part of that overall 150 crore investment that has been outlaid.
No, so what I was asking is, I mean, of 150, how much will be used for that? and what would be the ramp-up period? And is this particular expansion for the new rubber technology that you have designed and you're hopefully commercializing by 3Q as well?
No, so the investment made in the new technology of nickel rubber was made already in the previous fiscal year. And as I mentioned, that commissioning is likely to be completed now because of the approvals and the stabilization of the equipment that is going on. So that investment is not part of this. As far as this investment is concerned with the Q3 focus, there, as I said, I mean, it's part of the overall investment. I won't be able to provide you breakup of exactly how much I'm going to spend by Q3 and how much in the subsequent quarters. But so far, all the investments that have been made into the project, including the land acquisition, the part of the civil works, as well as the equipment advances and so on and so forth, have all been met from internal accruals.
Understood. And on EPR, you mentioned in the AGM that it's around 2 to 4 rupees that we got so far for the credit. So I understand the pricing is still will be decided by CPCB over time, but would it be possible to give an indication of how much credits that did we generate on 22 and 23, and how much have we sold already? Is it possible to share that?
I think the number of credits, as I keep saying, is something which still has a possibility of changing. Of course, our FY22-23, most of the credits, a large part of the credits have been sold, and Shilpa has already mentioned what we accrued as revenue from those. As far as the 23-24 is concerned, we have not started selling our credit, given the fact that the CPCB is going to set the floor price in the coming months as far on the price of the credit. The number of credits is, as I said, continues to remain dynamic because the policy is still undergoing changes. So I maintain the same stand. I won't be able to comment on the number of credits. We'll be in a position to comment on the revenue realized because we are not doing an accrual-based accounting. It will be a realized-based accounting because the prices are volatile. And until there is stability, there is no reason for us to provide any additional information on this.
Thank you. And the last question, retail rubber specifically, looks like there is, I mean, the last couple of quarters, there's a huge spurt in demand. Is there any particular reason that we're seeing such a spurt in demand? Because I don't see the tire manufacturers seeing that demand, but we are seeing a lot of interest, which is very nice to see.
So, I mean, the additional volume that we are selling is going mostly to the tire industry. So I'm not sure when you say that the tire industry is not talking about the demand, but yes, I mean, we are seeing increased offtake and supply to the tire industry as far as the material is concerned. The other reason for the likely spurt in the demand is also could be attributed to the high prices of natural rubber and synthetic rubber. Over the last few quarters, there has been an increasing trend as far as both these polymers are concerned. This has generally been a trend that when prices do go up, additional targets are taken by tire and non-tire manufacturers, specifically the non-tire manufacturers, to offset their costs. And we are possibly seeing the demand spurt on account of this as well. So it's a combination of A, the effort that the tire company is taking in incorporating more sustainable materials in their formulations, and B, the short-term spurt in the price of the virgin rubber that is leading to additional demand.
Thank you. Thank you so much. I'll get back into this.
Sure.
Thank you. Ladies and gentlemen, before we take the next question, I would like to remind the participants that you may press star and 1 on your phone to come in the question queue. The next question will be from the line of Rohit from iThought PMS. Please go ahead.
Yeah, hello, good afternoon, Harsh. Harsh, very encouraging to see the kind of aggression that we as a company are now taking. So I have a few questions. So first up, in this quarter and even in the last quarter, if I were to remove the EPR business and just look at the base business profitability, it seems that there has been a reduction in the margins, and this is despite we getting good volume. So if you can just maybe talk a bit about that. We were seeing good recovery in the first two quarters of FY24, but last two quarters we've seen this one in the Q4. If you exclude the EPR income, if you can just share a bit on that.
Yeah. So as I mentioned, I think I indicated that there's been a reduction of 2 to 2.5% in the realization rates because of the freight component on the exports. But look, exports continue to be a higher realization market, but because of our inability to supply to a lot of the markets, there has been a reduction in the export volume. So I mean, at a company level, we were trending at always greater than 50-55% of exports, which is kind of now moving a little lower on account of some of these headwinds on the export front. That has resulted in overall margin reduction as far as the reclaimed rubber business is concerned. As far as the non-reclaimed rubber is concerned, as I indicated, that our volume growth is also coming through on account of the bought out sources of raw material, which include ocean plastic and textile waste. And as a result of that, there's some sort of normalization of margins that is happening even in that business. So combination of this, yes, operationally there has been a little dip. I believe it's going to be a little temporary because freight rates, I mean, if they do normalize to the levels that we've seen in the previous quarter, then the margin accreditation will be much better. However, in the subsequent quarters, as I said, the impact on account of energy savings is going to be fairly significant. We've already started to see that benefit come through on account of wind and on account of biofuels. So those will start adding to the bottom line going forward.
Okay, got it. In terms of cost, were there any one-offs this quarter or not so much?
There were certain one-offs on account of employee costs. I mean, there have been, as part of the company completing 50 years, there were one-time costs in rewarding several employees across the organization, and costs associated with that were partly one-off.
Would it be possible to quantify it broadly, just to get a sense?
Shilpa, would you want to quickly give a broad sense of that number? But yeah, I mean, if I recall correctly, it's about 1.2 to 1.3 crores.
Got it. Okay. The other question that I have was in terms of this APR now. So you said broadly FY23 is done. Broadly, we may still have some bit. Now this year we sell for FY24 and FY25 as well. Is that understanding correct?
Yes. Correct.
So probably every quarter we will have some income from APR, right?
That's fair to assume, yes.
Got it. And in terms of this CapEx, now for this 150 crore that you're doing, let's say in the next 18 months, would you need any debt or this would be more back-ended for the next phase? How are you thinking about it?
No, we would need, as I said, I mean, there is the internal accruals, there is the approval of the rights issue of up to 40 crores, and then the remaining will be debt. It could be, but yeah, you're right. I mean, it should probably, I mean, we're using that as last resort in the sense that we would probably secure the facility, but avail for it only as we see being fit. I mean, as we deem fit.
Right. So you have mentioned three uses for three projects for this CapEx. So one is the plastic recycling business, the other is the crumb rubber, and then there is new technology so this is different from what you already have, or, I mean, because you mentioned we have already commercialized and now it's stabilized in new technology to produce reclaimed rubber. I'm assuming that could be under approval process, etc. So this new project that you're talking about, this is similar, I mean, expanding the same thing, or is it different?
No, so I mean, it will be crumb rubber and downstream offshoots from crumb rubber. As has been indicated, that, anything to do with EPR, there are multiple dimensions and multiple categories that have been approved under EPR. And so therefore, as part of that, crumb rubber is a basic necessity to launch into any of these other downstream products. And that's why we're taking the first step of investing in the crumb rubber facility, and then subsequent downstream are likely to get invested in as well. So I mean, one of the things that I did mention is possibly looking at carbon black or recovered carbon black as a category. because of the close synergy it offers with the tire companies, and availability of a lot of char is there because there are a lot of pyrolysis players in the country. So there are several such opportunities we are evaluating and testing technologies before we take a final plunge in the same. As far as the reclaimed rubber new technologies are